Ladies and gentlemen, welcome to The Plain Bagel. I'm your host, Richard Coffin. We are back once again. It's been a while, but coming back with another Investment Analyst Reviews, Investing TikToks, Part 6? Part 6. It's been a little while, in part because the online financial advice space is seemingly healing a bit. We've had some time to cool off. But with recent events in the market and perhaps retail interest coming back to the investing space, I figured I'd take some time to touch base and review again some finance TikToks. Now, if you're new to the channel, welcome. My name is Richard. I work as a registered portfolio manager with my CFA and CFP designations. And my goal today is to help clear up any misinformation that might be circulating on TikTok. Obviously, over time, TikTok and other social media sites have become more widely used by younger individuals to learn about finance and investing. And for sure, there's a lot of great information you can come across. But likewise, there's also a lot of lower quality content that can either misrepresent or just misconstrue important details about finance and how investing works. So my goal is to review some of these bits of content and try to make it educational and productive so that we can walk away learning more about finance and investing. And before hopping into it, I do want to give a big shout out to TikTok investors. In the past, I've gone and found a lot of these TikToks myself. This time around, a lot of them are coming from TikTok investors directly, which is a Twitter page directed to finding these tidbits of knowledge. So if you like this type of content, definitely go check them out. But without further ado, let's get into it. 4 ways to avoid taxes legally. We'll see. Love those TikToks. Oh man, the IRS is going to love that one. I don't know about the other videos, but they're going to love this video. So let's dissect this. For one, yes, it's true that you can deduct certain expenses from your income if you're self-employed, meaning you reduce your income taxes by lowering your total reported taxable income. And that includes things like if you're running a home office, some of the expenses related to that, as well as if you travel, you can deduct your travel expenses, lodging, and even some of your meals. But for one, you can only do this if you're incorporated, not if you're a typically salaried employee. And two, there are criteria here. The expenses have to be quote unquote reasonable. The principle of this mechanism is to allow businesses to deduct expenses that are required or contribute to the generation of the revenue in some way. So lodgings during a business trip can be covered. Meals with potential clients might be covered with some restrictions. And anything like that can, yes, allow for a deduction because it's helping you grow the business or, again, contributing to the revenue generation. But tax authorities do consider intent with expenses. And if you throw your wife into a corporation when she's not actually doing any work there, and you go on a vacation, you expense every personal expense and all these lavish meals, and then you post a TikTok about how you legally avoid taxes, you and the IRS might have some words, especially if they see that these restaurant expenses and the like make up a significant portion of your company's expenses. So hopefully this goes to show that tax is a complicated matter. And if you want advice, TikTok is not the place. You should reach out to a professional like a CPA, someone who knows what they're doing.
This is what index fund gurus don't tell you about index funds that make me so angry. Yes, investing in index funds is better than not investing at all. And I think if you follow me, you probably understand the importance of investing. So that's not the issue, right? After I grew my investment portfolio from $500 to millions of dollars, I decided to listen to one of the index fund gurus that popped onto my social media. And I'm like, you know what? Let me add an index fund to my portfolio. Do you want to see the results and the difference between individual stocks and index fund? I'll show you. Understand that even index funds, the best of the best index funds, majority of their growth are basically carried by like a handful of stocks.
That's actually true. I think I know where she's going with this, but it is true that especially with the S&P 500, which is one of the most popular US stock market indices that a bunch of people invest their money through, it is true that a lot of its return, especially recently, has been sort of dominated by just a few positions. First half of 2024, there were 5 stocks, I think it was the top 5 biggest stocks in the index, made up 2/3 of the S&P 500's return year to date. So it is true that at times the index's performance can be dominated by just a handful of positions. Although that does have to do more with the weighting mechanism of the index and the fact that larger companies recently have seen some of the best performance.
If you just spend a little bit more time, a little bit, we're talking about 1 hour per week, this is how your results can be different. Watch. Here's my $4 million portfolio. Look at the gains here on individual stocks starting from 200% until we finally get to VU here, which is way lower than my top performing stocks that are basically carrying my entire $4.7 million portfolio. And I do it all in only 1 hour per month, even though I'm super busy and not a math whiz.
I thought we were 1 hour a week. It's getting better. The deal's sounding pretty good.
Following my simple 5-step diamond system. Comment diamond, I'll send you my free masterclass on it.
Sounds super fake. I bet. Let me see if I can find what this diamond process is.
If you're a long-term value investor, all you need to know really is have certainty if this company or asset is going to be around in 5 or 10 years. So we had capital, intentional, fundamental. Point number 4.
Wait, no, that's why I'm here. I thought this was a step-by-step process on how to analyze. You can't just put fundamental analysis as step 3. So right away, a lot of red flags here that should really make you question or be critical of these claims here. For one, very strategically hiding a lot of the details while cherry picking the figures we see. The gain percentage, for example, we don't know what time period that gain is shown over. It could be 2 days, it could be 10 years, which would obviously impact how impressive the performance is. And we're sorted by gain and starting at the top and going down the list and very strategically, again, stopping at VOO, refusing to go lower to show the negative performance in the portfolio, which would lead me to believe there's probably some very ugly performance figures that are being hidden under VOO, and obviously makes it impossible to gauge how well she's actually performed. And the second point is that the idea that all you have to do is pick the best stocks is a really flawed way of thinking, because while it sounds very easy or feasible when you frame it that way to say, hey, all you have to do is pick the best 10 stocks to see great performance, it's actually quite the opposite, where because a lot of the index's return is fueled by just a few positions, it's incredibly difficult to find what those 10 or so positions are in the mass field or ocean of positions that exist out there. To put it a different way, imagine it as probabilities. Imagine you want to invest in the best 10% of the S&P 500. Picking just one of the top 50 stocks has a probability of 10%, which is not bad, but clearly difficult. You have a 90% chance of picking a stock outside of that top 50. And building a portfolio, or let's just say picking 10 of the best 50 stocks, has a pretty low probability. And you might think, well, yes, that's a flat probability, but let's say I have a strategy that gives me the advantage to go and find those top positions. But there's just nothing so simple that you could apply 1 hour a week or a month and find those positions. It would take an hour just to read through a company's most recent filings and learn what they even do, let alone to use a 5-step diamond system to analyze a portfolio of 20 to 30 stocks. Now, if you want to stock pick, all the power to you, but you do have to go into it with the proper expectations, education, and understanding of how much effort will be required. Even the majority of mutual funds where you have teams of analysts spending their workdays researching stocks, the majority of them tend to underperform. The nice thing about index funds is they do broadly diversify your holdings so that you limit your exposure to individual companies and don't put your retirement savings or whatever at risk of just a handful of positions failing, or conversely missing the performance of the top performers driving the index's total return. I definitely think that approach, or going with another managed solution, makes a lot more sense than the everyday Joe just picking stocks with 1 hour a week. All right, this is a red one. How much I made today using Tarot and intuition to day trade options. After scanning the market from 8:30 to 9 a.m. till 9 a.m. and picking the stock I'll be trading that day, today it was Amazon, I do a single card pull to confirm my decision or get guidance. Today I pulled the Ace of Cups, which represents abundance. This gave me the needed assurance to trust in my strategy. I'm just noticing the account name Blonde Rich Witch. 21% return in 8 minutes by trusting my higher self. Yeah, the thing I said about nature healing might have been preemptive. What's interesting is there is actually a research article, I think I've highlighted it before, about how the stock market seemingly sees different returns under different phases of the moon, which might lead you to believe that there's something to this astrology thing, and that we should all start charting the moon for our investment portfolios, which quite frankly isn't that far off of what a lot of day traders do anyway. But hopefully it goes without saying that no. It's just an example of data mining, right? If you look across enough numbers of data sets and correlate it or run the correlation numbers with the market, you're going to find something that has a rough statistically significant correlation to market performance, even though, of course, correlation does not equate causation. Just because two things occur or move in the same direction does not mean one thing is causing the other. And of course, like I mentioned, you have to be incredibly skeptical of any performance figures provided, especially just kind of one-shot screenshots. Really, the only thing that you should judge someone on is their comprehensive long-term performance figures. If you aren't seeing how their entire account has performed over a longer period of time, and you can't verify that figure, you really shouldn't even bother considering whatever numbers are being thrown at you, whether it be 2% or 2,000%. You need to have the full comprehensive view of things to really gauge someone's ability as a stock picker.
Study the wealthiest. I don't mean Bill Gates and Warren Buffett. I mean, if you study Goldman Sachs, that's where the real wealth is.
Okay.
Study the wealthiest.
Explain that. Why isn't it Gates and Buffett?
Because they're only worth 80 billion.
Okay.
Okay. You know, Goldman Sachs will destroy 80 million in an hour.
As far as their income, their revenues,
You're talking about Vanguard controls $5 trillion of ETFs. That's money. There's endless amounts of money. Like, I don't know what the Queen controls, but it's freaking massive. Or the Putin money. You're not talking about all that dark money, all the black in the shadows money.
Where is this going? What? I don't know what the takeaway was. Yeah, if you're trying to be like Bill Gates or Buffett, you're thinking too small. If you want to be big, you got to study the biggest of the big. I'm talking JP Morgan, Goldman Sachs, BlackRock. If you're not managing $10 trillion in assets under management by the time you're 25, what are you even doing? Come on, get a grip. Grant Cardone, treasure trove of this kind of content, just always one-upping the weird mental exercises.
Best investment in the world today. I'm not kidding you. Better than real estate, better than oil, better than gas is silver, because this is going down. When this goes down, the rupee goes down with it. So if you want to get rich, get silver today. Best investment of all. This is $35 US.
Man, I don't know what happened to Robert Kiyosaki, but if you aren't familiar, he used to be a very well-known author for some personal finance books. Haven't actually read them myself, but Rich Dad, Poor Dad, The Four Quadrants, I think is the name of the other one. And these days just predicts a crash every month or so. Kind of like just the general movement of the finfluencer space as a whole. But silver, to talk about precious metal investing quickly, I've kind of touched on it here and there. Yes, it is true that historically we've seen precious metals like silver have seen their price increase during times of turmoil. For example, back in 2008, we saw it shoot up 350% in price from a low in 2008 to a high in 2011. But it hasn't been without its issues, and the price of the metal has actually not been able to since reclaim that high. It's interesting that he's talking about silver here. Silver and gold have actually long competed for dominance of the precious metal category, and as a result, investor dollars. But gold has, for the most part, come out on top, and is trading at a much higher price and has seen a much better return over the long term. And what's interesting with investing in precious metals is that obviously a lot of people will highlight how scarcity is what determines something's value. And that's why gold is hard money and why it's sure to continue increasing in value over time. What's interesting is that part of gold's value, while it's sort of viewed as a sort of formulaic thing, it is in part a social phenomenon. There are actually other precious metals like platinum, for example, that are rarer than gold and harder to come across with many of the same properties that actually have more industrial applications and yet trade at a lower price, with platinum trading at half the price per troy ounce of gold. And the reason why gold has dominated other precious metals is really just sort of social inertia and social phenomenon. There's actually a great book by anthropologist David Graeber called Debt the First 5,000 Years. It was actually suggested to me by Yuri over at Money and Macro, so Thanks for that. But in this book, he argues that gold's societal value actually stems from its use in religion and how it was used to adorn temples and paid as tribute due to its shiny, non-corrosive properties. And that over time, that's just translated into its use for financial purposes, especially because historically, temples were sort of de facto financial institutions for the societies built around them. And we get a little lost in the tangent here, but it just goes to argue that while some people might view the increase in value of these precious metals as formulaic and based entirely off of scarcity, because something's limited in supply, therefore its price will increase. There's more to it. And predicting the price of a precious metal is the same as trying to predict recessions and human behavior. It's near impossible to do. It's why I like to focus on producing assets, where instead of just hoping that something will see its price increase, I will invest in a company or something that I actually hope will improve over time, generate more and more profits and grow its operations, which should lead to its price increasing as a result of that, rather than just scarcity. Finishing off with another Grant Cardone video. Like I mentioned, treasure trove of content.
Every 15-year-old kid should be doing this right now. If you're getting an allowance of $300 a month, buy a piece of real estate that pays you $30 a month.
But how would a young, normal person get money?
Allowance, side jobs, side hustles. I was 14 years old. I was working every weekend. I was mowing lawns, doing whatever I could to get some extra money.
So seemingly the lessons from Grant Cardone here are become a literal bank and buy real estate when you're 15. Easy enough. Now, obviously, there's nothing wrong with kids trying their hand on entrepreneurship if, say, they want a bit of extra cash. There's stuff they can learn by doing that. But assuming that kid doesn't need to work to support themselves, I don't see a crazy amount of value in pushing 15-year-olds to work every weekend. There's stuff to be learned by doing that, but the money's not going to be significant compared to, say, your first career income that you're going to earn if you focus on schooling and say develop your skills. And you need to leave room for being a kid, right? These are formative years. There needs to be time to be a kid and develop your soft skills and your social skills. Obviously, this can come down to difference of opinion, but I don't like videos that can convince a younger, impressionable crowd that they should be spending every waking hour hustling on their weekends to make a little bit of extra cash. Oh, and I haven't even gone to the real estate part, telling kids to buy real estate. I don't know if you legally can. But I wouldn't recommend it. It's a lot of stress for a child, and a lot of money. We have people with careers struggling to purchase properties. I don't think a lawn mowing weekend practice is going to cut it. Maybe if you start investing your rich parent allowance as a baby, you'll have enough for a down payment by the time you're 15, but that's about it. Math doesn't really check out here. Anyway, just my 2 cents. A lot more to life, especially for kids, than just chasing dollars. Anyway, that's the video. Thank you for joining me today for another TikTok review. As I mentioned every time, there are great videos out there giving good information on finance and investing, but there's also a lot of noise you have to cut through. So hopefully this video helped a bit with that. If you thought it did, please do make sure to like, subscribe, all that good stuff. It does help the channel tremendously. And let me know in the comments down below your thoughts on any of the bits of information covered today. Thanks again for joining, and as always, be safe out there.